Hello, my friends. Ben here. Hope you're all surviving the market mayhem that's been going on. It's been pretty much all over the place, and who knows how it's all going to play out at the end. All I know is that the kind of buy and hope model, or just being long only, primarily in tech stocks, has been a rough place to be this year. Okay, so we have seen a lot of big moves, massive intraday swings, and a lot of it has been based on FOMO and this fear of missing out or panic reactions, things like that. It's pretty classic. It happens in this type of market, and who knows if we're out of the woods yet. We'll find out sooner or later. This is a trader's market, okay, where you not only want to protect your capital, but also set yourself up to make a killing on the long and short side if you know what you're doing. So as many of you know by now, we are an educational company, okay? We teach you how to build a book of trades that are fundamentally based relative to what's going on with a macro picture and what's happening in the world. And then we run those ideas with options. So we are pure alpha traders, basically, similar to most hedge funds. And no, our ideas don't always work out. And that's okay. We have limited risk and greater upside potential. As long as we have more winners than losers, we're fine in any market environment. So let's just have a quick look to see what's been going on the macro front this month, just besides the tariffs. Okay, so the key ISM data for March that was released in the first week of April, disappointed. Readings showing contractions in the manufacturing space. But the real kicker was the services part of the economy. That was just a massive miss. Okay, and the biggest problem across the board really was weaker new orders. Now, this was followed by the FOMC minutes where the Fed downgraded the growth forecast for this year. So it's not like the warning signs haven't been here for a while. We're now actually starting to see a pretty decent rebound after all this. And the inflation data that came out was actually pretty weak. However, the Fed is still being stubborn, with concerns over potential inflationary pressure going forwards, building up from the tariff situation. That said, they are committed to rate cuts, probably in June. Maybe it'll be sooner, should really be sooner. But they're kind of stuck, because they can't appear to be bending the knee, so to speak, to Trump, who's really pushing hard for them to cut rates. So we'll see how that plays out. Now, speaking of inflation data, downward pressure came from airline fares as well as recreational activities and travel, which makes good sense. It's what's happening. People are just have been losing money in the stock market, and are just, when that happens and people get scared of the economical situation, they usually back off on large purchases, like discretionary spending falls. And that leads to a slowdown in things like travel, airlines, cruise lines, anything that goes with it. And there are a lot of ideas that I can think of that fits into that kind of narrative, with airlines, hotels, whatnot. But a lot of them have just been hammered pretty bad at this point. So you're kind of basically probably too late to the party. But there are other ones that I believe have a better chance for another leg down. And I like to look at several drivers and catalysts in a trade idea, not just one. So with that said, I'm pretty bearish on Disney right now. And there's a lot of things going on with this company. First of all, the ticket prices for theme parks have really skyrocketed. So now a one-day pass to Magic Kingdom is around $130 for kids 10 and up. And it's still $124 for younger kids below that age group. And it's double. I used to bring my kids there for when they were little, 20 years ago, whatever. In the past 10 years, actually, prices have doubled. So that's insane. It's going to be over $500 per day for a family of 2 adults and 2 kids just for the entry fee. And then, of course, there's an inflated price for parking, accommodations, food, and all the other stuff that goes with it. So I think Disney will see less foot traffic as people in general will just be more careful with discretionary spending in the light of what's going on. And big tourist attractions could suffer. And half of Disney's revenue come from experience, such as theme parks, cruises, things like that, and not only in the US, but also abroad. And we have seen signs that in Asia specifically, the Disney theme parks there are just not doing well at all. So I just don't see how this total picture will not continue to suffer this year. And then, of course, there's other revenue streams, okay, such as movies. And the latest Snow White movie just flopped completely. Okay, it was turns out to be around a $300 million loss. And that's just for the movie. You know, then you have to think about all the merchandising and everything else that's going to go with it. That would also struggle, really. So here we're looking at a weekly chart of Disney, and with the stock around 85, you know, it has dropped a lot since March of 2021. Struggled big time. So if the stock can't perform in a strong economy, like how is it going to do in a potential recession? Now the stock, with the stock at the lower end of its range, pretty much, yes, there's a good chance it will kind of grind sideways, even a bit higher in the near term. That's fine. We're going to structure it accordingly when we look at the options. Okay, so speaking of headwind, the current sell-off in the US dollar could eventually lead to a renewed interest in US travel from foreigners. So there's that. But I don't think that's going to happen this year. With this trade war raging and this kind of whole anti-US sentiment going on, I think we could see a lower leg in this stock at some point. So we're going to have a quick look at the quants. Earnings growth, okay, it's forecasted to around 10% for this fiscal year, which that's not terrible, but it's a drastic deceleration from 32% bottom line growth last year. And revenue growth is just an anemic 3%. And I think these numbers might even be too optimistic. So, you know, they have earnings out on May 7th. I think we can set this up so we can benefit from that. So let's have a look. A little option refresher real quick. You know, the price of an option premium is primarily made up from the price of the underlying stock plus time to expiration, which is time value, plus implied volatility of the underlying stock. So basically, the likelihood of a stock having a big move either way, and a few other elements. Anyway, right now, the volatility in such a way that it has really inflated the option premiums. Okay, so we can hedge that out by setting up this structure, as well as hedging out time value. So in any case, this will be a bearish vertical ratio spread for June, and it looks like this, where you go long 20 of the Disney June 85 strike puts. Okay, at $3, that'll be a cost of $6,000. At the same time, you sell half that, because the ratio, you sell 10 June 75 strike puts at 110 for an $1,100 credit. So like that, we have unlimited upside over earnings that's coming out soon, while also collecting a decent credit. So the total cost is $4,900 for this setup. That is also max you can lose. So let's say, you know, the stock is at 75 in June. Okay, then it will be 85, which is a strike, minus 75 price, minus the $3 cost. Then you have to multiply the 20 size, okay, times the 100 multiplier, because one option controls 100 shares of stock. So for the long leg, it will be a $14,000 profit. And then we get the $1,100 credit for the short leg, which we will get as long as the stock stays above 75. We'll add above 75. Okay, so the total here is $15,100 profit, which is a 3-to-1 reward risk, with stock at 75 in June. Now look, clearly there's lots of other scenarios that how this can play out. Okay, this is just an example. And by the way, if we lose, if the stock stays above 75 and we just don't do anything about it and we lose our max risk, okay, of 4,900. But there are actions we can take in between to minimize that. And that is a wrap, my friends. Like always, stay in tune with what's going on. Have a plan, execute. Until next time.